Hi, welcome to Let's Talk Real Estate. I'm your host, Charlie Flannery. We have a very special guest, a celebrity with us today. He's a mortgage consultant. I'd like to welcome to Let's Talk Real Estate, Mr. Ed Mcmahon.
Thank you very much, Charlie.
Thanks, Eddie. Thanks
you,
for
sir.
coming. Yeah, so I know Ed and I have been friends and done business for at least the past dozen years.
Sure.
And so we go way back, and a lot of Portuguese steak sandwiches
That's
downtown.
right. The best.
And I wanted to talk about what's going on, because with the mortgage business and the financial crisis. I mean, there were days when I feel like I'm sitting at the bar on the Titanic. We've hit the iceberg, and no one has even sent out a distress call yet.
It's a real good way to look at it. That's the
So,
climate we're in.
Are you sensing any optimism anywhere out there?
I'm a positive thinker, and I try to do that every day. But it does. It gets more difficult every day, and it seems like interest rates are just great. There's so much relief that we could offer people. The phone rings all day, but when it comes down to it, something stands in the way, whether it's value or lending is definitely getting tighter once again.
The banks are sitting on a ton of dough.
Yeah.
They've got so much liquidity, but they're not putting it on the street.
No, it's many people are calling in and looking for relief, and it just has to be an almost perfect loan, it seems.
There must have been a time when the refinance business probably was 70% or better of your action.
Definitely, and it still is actually, but it's becoming more difficult, and we're gearing up starting this month. We've had meetings, and we're really gearing up to make that change into the purchase market. We think that you have to survive. You're going to have to be in the purchase market because of home values, where they're going. So many people, owing more than what their home is worth right now.
They're underwater.
They are.
Which is the common term. So even though I think that if people go an FHA refinance, they can go up to how much?
Just here under 98% on a rate and term. So
just for the folks at home,
sure.
A rate and term means they're not pulling any additional cash out.
Right.
What they're doing is they're getting a lower interest rate and perhaps changing it from a 15 to a 30 year to get their payments down.
Right. Term reduction, where the rates are now, we're doing quite a bit in the way of term reductions. If someone has an interest rate at 5.5%, we can often bring them down with an FHA loan around 4%, eliminate several years of mortgage payments and keep their payment about the same. So we're doing a lot of term reductions right now.
The problem is, I would imagine a lot of the people that did refinance, there was that refinance frenzy that people were refinancing
Sure.
every 6 months.
Yeah.
And they may have gotten, what amounts to 140% of value they owe today.
Sure. It's not
those
uncommon.
people,
Right. I come across it all day long.
you can't bail them out.
No, it's we have programs, relief programs, FHA, other government relief loans. We'll go up to 100%.
Yeah.
But most people I speak with right now, I'm licensed in 9 different states, Massachusetts being one of them, and most people I speak with, there's a great benefit to be had if their value is in line, but for the most cases it's not.
And then I've been told that many of the big banks, they have actual percentages worked out, almost like an insurance agency or an insurance company has an actuarial table. They've done calculations where they figure when a person gets 20% underwater, they start wondering, is it worth the $3,000 I'm paying every month? When it gets to be 25%, a lot of them have said, no,
Right.
it's not. And then by the time it reaches, I don't know if the magic number is 30 or 35% underwater, that's when people decide to leave the keys. And I know, and virtually every other realtor that I speak with knows someone who's been in their home for, in many instances, up to 4 years without making a mortgage payment. And these lenders haven't moved to foreclose.
Right.
So, I mean, we still got that albatross, about to wrap itself around our neck.
Sure.
You know?
There's just so many foreclosures out there, and the market seems to be flooded with them. And I talk to these people, like you just mentioned, who are in their home, who have given up the struggle with this economy, their employment, and they know that they're underwater, as you say, and they give up the fight. And the banks, I think, are hesitant now to foreclose and are trying to work out more modifications and try to work with these folks. And I think that's a case of just having more on their plate that they can handle. They'll get to these folks sooner or later and something will be done. And, hopefully a loan modification.
Well, the loan modification begs the question, where does that money come from? Modification, it's a nice word to throw out there, but it means they cut the principal amount of the loan. The guy no longer owes 300, he's down to 250 or 200.
Right.
Where does that 50 or 100,000 come from? Usually, the short answer is we, the taxpayers.
Sure, and a good modification would be, and I see them quite a bit, is maybe a $50,000 reduction in principal, and I'm seeing rates in the 2s and 3s, and these are rates that for 3-5 years, and then the bank's going to take another look at it. But the good loan modifications are when the banks work with the client, and that principal's, if they refinance in the future, or if they do something, that has to be repaid back. But it'd be nice if it doesn't come from the taxpayers, but in the long run it does.
So that debt, it's almost like a bifurcation. It's split in two. It's not really forgiven. It's still on the books. That $50,000, they're just not paying interest on it. It's just sitting.
Most of the modifications I come across,
wow.
It's still there if they regain equity, or if they sell, or if they refinance. It has to be paid back in most of them. Sometimes maybe not.
So that gives me further reinforcement in my belief that we're really 10 years, I think, out from seeing a rebound to anything resembling a good, healthy market.
I think you're right, and I think that has a lot to do with, I don't know if many people know how big this real estate bubble grew. Values just increased so fast and so much year to year. It was 3-5% a year, and then where it went. It went up. Homes were 15-20% a year. They were increasing, and I just think we're going to see a big market correction. And I'm one who, again, I'm a positive, optimist person, but I think we're going to see values come down, maybe another 10 to 20%. Before things level off and things get right again.
I agree.
Yeah,
I mean,
really
we've got a lot of bleeding to do.
Yes.
And so I guess, that now you talk about your refinance business being, hobbled because people are underwater. And so you're trying to switch to buyers. And every time you start talking about the buyer's market, it's all predicated on the first-time buyer.
It is.
If that person doesn't come along and buy my 2-bedroom ranch, I can't buy your 3-bedroom Cape, and you can't buy your 4-bedroom McMansion with the 2-car garage and the pool on the roof.
You're absolutely right.
So as soon as I get shut out of the game as a first-time buyer, it's game over. So, if I were a first-time buyer, I'm a young person, I'm 25 or so, and I'm thinking about buying my first home, I'm weighing my options. the rates are probably never going to be this low again.
Right.
And yet I can probably pick up something really nice for 175 or
You can.
200,000.
Oh, you can.
It could drop from 175, 200 down to 150 to 175, but but by that time the rates may be up at 6%
Sure.
or 7%. I mean, they're so low, they're down below 5.
Right.
What are they around today?
The average, if you have, the average with the average credit score, you can say a 30-year fixed 4.75, 15 years are down around 4%. And it's time for the first-time buyer to come out. It really is. Sure, they may lose some equity. Most of the first-time buyers will do an FHA loan, 3.5% down, good loan, good low rate, and the price is right in the market for the first-time buyer to come back out, and they will do a lot of healing if they do. They really will. And if interest rates, the government has been involved, and they're in the bond market, and they're helping keeping these rates low like they are, and that's going to stop. And I've been told in the near future. So once rates go up to the mid-5%, 6%, even if they bought the property for tens of thousands less, it doesn't really accomplish anything.
Right. You'd have to, that 10% reduction in value that they may experience if they buy today at, say, 5% versus what the payment would be at 7%.
Exactly.
Right.
It's a great time for the first-time buyer. I used to do a lot of purchases, and with you and the other realtors in the area, and the first-time buyer, they were almost 75% of that business. And I noticed when values rose and rose and rose, and once they got up around 225, 250, the first-time buyer, I didn't see them that much anymore. The market got away from them. But right now, the prices are back again. You can get a really nice starter home, 175, well under 200,000, and with these rates, it's probably less than you're going to pay for rent, and the tax write-offs for mortgage interest and for the mortgage that you get. It's time.
Well, there's talk about doing away with the mortgage interest deduction.
I know, I've heard that.
That's being kicked around as what they call a revenue raiser.
Yeah.
I mean, that would, I think that alone, if they eliminate that, probably you're talking about, I've heard 15 to 20% additional collapse.
Yeah, you've got to, the homeowners, not so much the first-time buyers, but those who are on the edge or are underwater, whether it's a lot or a little, and they really need that write-off. The way this economy is, at least, if it's in the average household, if the husband and wife are both working, someone's lost their good job and now, just a mediocre, and they really need every tax break they can get. And
I watch, occasionally I'll watch those TV shows, and they're showing homes that have been remodeled in California, and it's like an 800 square foot ranch, and they're asking $795,000 for it.
Right.
Now, call me old fashioned, but if somebody can afford to buy an $800,000 home like that, I don't think they need my assistance with a tax break for a write-off. I mean, I think they need to finesse the issue, just like the current debate about income tax levels has been about what your income tax actually is. They're trying to have it be a little more progressive. I think we need to finesse the mortgage interest deduction. I know that the National Association of Realtors, they're pushing very hard to just keep it as it exists, the status quo.
Yeah, I'd like to see it stay, but it's a good point.
In this economic climate that we're in, I don't think anybody should go to the negotiating table expecting to get 100% of what they want.
No.
I think everybody's got to put something on the table.
I
We're
agree.
all in this together. How do we make this thing whole?
I agree.
Because if we don't, we're gonna spend the next generation muddling through it.
It is. It's getting more challenge every week, every day, more of a challenge, and You know, many calls come in to me in the course of a day or a week, and if I can give great relief to 2 or 3 borrowers looking to refinance, it's a success. So,
All right. Well, I'll tell you, we're coming up against a hard break for a couple of public service announcements, but please stay tuned for more of Let's Talk Real Estate. Thank you.
Some things require experts at every stage.
It's one small step for man, one giant leap for mankind.
Others are more just a matter of taste and preference.
Just the way I like them.
Buying a home falls somewhere in between. That's why you should visit HomeLoanLearningCenter.com for expert guidance. A website where you can learn just how you should go about buying a home. You'll get facts, tools, and impartial advice. From seeing a lender to settlement and beyond, there's a step-by-step explanation of the process. All at HomeLoanLearningCenter.com.
Houston, we have a solution.
Think of it as mission control for buying a home. That's HomeLoanLearningCenter.com.
This is a message from HUD, the U.S. Department of Housing and Urban Development.
Can you afford your home loan? Could your mortgage payment increase in a few months to something you can't afford? Hi, I'm Ruby D. If you're not sure you can continue to make your mortgage payments, call a government-approved housing counselor in your community for free and confidential help. Keep your home. Know your loan. Call today.
Call 877-HUD-1515. That's 877-HUD-1515 or go to HUD.gov.
Hi, welcome back to Let's Talk Real Estate. I'm still your host, Charlie Flannery, and my guest today is still celebrity non pareil, Mr. Ed Mcmahon. Ed, thanks for not running out on me on the break.
I wasn't going to run
It's
away.
happened before, really. Not with you, but with others who shall go nameless.
Okay.
Their initials are, we were just talking about que desastro, the mortgage market. I find we as realtors, and I myself, we're having to be more creative every day, finding new ways to paint the barn. What are you mortgage guys trying to come up with to throw against the wall and see what sticks?
Well, we just started reaching out to not just first-time buyers, but home buyers. And in the early stages, we found many of them have a plan, would like to upgrade, would like to buy their first home. But there's a lot of fear of the economy, what's going on with their job. Is it the right time? They think their jobs are secure. And I think mortgage lenders are starting to think outside the box a little bit. What we do, for example, to help the buyers and the realtors we work with, we will, if someone purchases a home or they do their mortgage through us, whether they're a first-time buyer or not, and then if they lost their job, we will pay their mortgage for 6 months while they're looking for another job.
Huh.
So that gives them some comfort, and they could look at several homes and it could help. It could, ease some of their concern.
Now, fear is always a big factor.
It is.
There's so much. Fear is what keeps people from doing what they came here to do,
Right.
which is buy or sell.
Right.
And now, that program, 6 months, is that something where those 6 months payments are forgiven?
Yes, there's no extra cost at all to the borrower.
Huh.
If they're eligible to collect, the guidelines are if they're eligible to collect unemployment, as long as they didn't do something to get fired and
Right.
and then, but basically up to $2,000, so for 6 months, and our clients love it. It does it, and that's even
$2,000 per month.
right.
Yeah, okay.
And even on a refinance, we do the same thing.
That was my next question.
And it does ease some fears and concerns,
Sure.
and it helps us to get a greater percentage of business, because although there's a lot of potential clients out there, there's really not a lot who are qualified and have the equity to. So it does separate us and helps us to get a bigger share of business.
Has that program been implemented yet, or is it just in
It
the
is.
launching stages?
We just launched it about 2 months ago, and it's implemented. I don't know if we're the only company to come up with something like that, but this is what you're starting to. Things are so rocky right now that we're just trying to do everything we can.
Think outside the box.
You have to. You have to.
Yeah, you got to be able to think on your feet.
That's right.
You know, it's one of the things I always tell people if they're thinking of pursuing a career in real estate. I said the qualities you need are honesty, integrity, and an ability to think on your feet. I can teach you everything else you need to know.
That's right, especially in this market. It's very challenging times.
So, how real is this threat in Washington of going to the mandatory 20% down?
You know, I've heard talk of it. I think it would hurt the market so badly. I don't think there is much of a threat. I don't know how you feel about that, but I just think that would bring things to almost a standstill. It would really, in my opinion, cause the market to slow down to the point where values would even get, far lower than we're even talking about. So I'm hoping that that's just rumor, and I just can't imagine programs like FHA going away, although they are experiencing a lot of defaults right now. It's in this economy.
Well, getting back to that first-time buyer, it seems like the one unchangeable fact is many times you have a young couple or a single person, man or woman, seeing a lot of single women buying homes today. That's a good thing. As a father of 4 daughters, I'm always encouraged by that. I have a place to stay.
Yeah, that's right.
But the one immutable fact is, these people are just getting started in their careers. Many times they're saddled with huge, college loan debt, and saving, even if it's 3.5% of $200,000. I mean, that's in many instances a difficult task coming up.
It is.
And then some closing costs. So say $10,000 to $15,000. It's difficult for a first-time buyer, and yet they're still only making X amount of dollars, even if it's a couple and you're pooling your money. So those are the things you can't change. You can't change how much money they make. They're going to be burdened with debt, and they've only got limited money to work with that they borrowed in many instances from Uncle Tony to help them to purchase the house.
Sure.
All right. So admittedly, the pendulum tilted in the wrong direction when no one had any skin in the game.
Sure.
But you show me a young person or a young couple, or whatever, they're throwing between $7,000 and $15,000 into a deal. That's a lot of money for them.
It is.
And they're not going to walk.
No, they're gonna hang in there, and they're gonna get roots. Single family home where they bring up their children, and they'll get roots. And the first time buyers, they can finance most of the closing costs. So I think it's very reasonable for them to come up with a down payment of around 3%, and you and I know you can always work in the closing cost to the loan, and they're not too bad, but it's good. I believe in having some commitment from the buyer, have them, at least 3%.
Yeah, and it's not like we're talking about someone that's established in their career. They're at their peak earning years.
Right.
They've saved some money in their 401k or whatever it may be, and these are people that are scraping and doing without, you know what I mean, or counting on help from family. And so then, that $10,000 means a lot more to them than that person who's, say, 50 years old in their career, peak earning years.
Definitely.
They're not. I think we have to keep believing in those people. I would start singing "Don't Stop Believing," but
I agree. I find most of the people I spoke to, and it's many of them across the country every day, were in loans where they did put no money down. They did the 80-20 loans where they borrowed the whole amount, and I think that's where it began. You know, it was just, you know, I can't really do anything for those folks now. There's nothing to really offer them.
Right.
And back then the rates were pretty high, so there is a struggle there, and they see that they're in a loan where they're underwater, they have a high rate, there's no relief, and I think that's why they surrender and walk away also.
In many ways, the one thing I do take encouragement from is, particularly when I'm talking about younger people, that first-time buyer demographic, I think in many ways I'm witnessing the forging of the second greatest generation.
I hope
You know,
so.
they've been forged through the hard times, just like,
Yeah.
you know, our parents went
Sure.
through the Great Depression. These people have seen what's happened with real estate values. They've learned the value of a buck. Many of them have served in the armed forces nobly, and now they're back, and they're mature beyond their years.
Sure.
So I mean, I take great encouragement, you know, because I talk to a lot of younger folk, and God, for the typical 25-year-old that I talk to today has his head or her head so much screwed on better than I did when I was 25
Yeah.
years old. Oh my
Well,
gosh.
It's enlightening. It is, and you know, there's still the you mentioned the military, and I really like the military loan, the VA loan. When someone comes out of the military, that loan is still 100%, and I find that those folks I deal with are very, very responsible, and I do believe in that loan at 100% for our military who has served.
Absolutely. Let's keep
Yeah.
the VA going.
I agree.
And you know, don't abandon our troops when they come back. They need all the help and all the gratitude we can show to them. We're going to have to be wrapping up our show today. I want to thank you for tuning in. I want to thank Mr. Ed Mcmahon for being my guest. If you'd like to have me send a question to Ed concerning mortgages, please send an email to letstalkrealestate@verizon.net. I'll get that question right out to Ed. Also, if you'd like to have a copy of today's episode, you can send in an email. Again, it's letstalkrealestate@verizon.net. Please include your name, your address, and your phone number so that we can verify, because these are expensive. We can only do that for the first 100 respondents. And we're trying something new. If you think you have a topic that you'd like to talk about on Let's Talk Real Estate, send an email again to that same address and put on the show. And I'll follow up. Maybe we'll have you on as a guest one day on Let's Talk Real Estate. Once again, Ed,
Thank you,
thanks
Charlie.
a bunch for being
Thank you very
on.
much.
Good luck and stay safe.